Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host.
Well, that was a very enthusiastic introduction. Your co-host Andrew.
It's the coffee.
It's the coffee.
It's definitely the coffee working. So away we go. So my co-host Andrew.
Yes, your co-host Andrew's here. Sorry, we need to get us back on track.
What are we talking to everybody about today?
Yeah, so today we're talking about something that we've recently spoken to some clients about. So we thought that it'd be nice to jump on the podcast and share that knowledge around, and that is a debt recycling strategy.
Oh, that sounds interesting.
Yeah, it's exactly the same as recycling when you think about putting your trash in there. Sorry, we're silly this morning. I'm sorry. No, but it's definitely a very worthwhile strategy that what you're looking to do and what you're trying to do is change or move your debt from non-deductible, so bad debt, and move it to deductible debt, good debt. Really simple.
Podcast over. So let me just preface this a little bit.
Bring us back on track.
We've been silly. In terms of the environment that we're in at the moment, we've been having conversations with people and it's become a much greater consideration around your home loan. Because interest rates have gone up, it's more difficult to service a home loan, and in turn, it becomes a greater challenge to pay off your home loan faster because you're using more money to service the same level of debt, and you can't necessarily use that money for additional repayments to pay it off quicker. So this is a really fitting time to sort of remind our listeners and our viewers around what debt recycling is. We did a debt recycling podcast way back when we first started the podcast, back in the early days. So realistically, this is just a way to accelerate the speed at which you pay back your non-deductible owner-occupier debt. So that's kind of it in a nutshell, but it can get a bit complicated when we're talking deductible and non-deductible and good debt versus bad debt and stuff, but bear with us. It's a really worthwhile strategy, worth considering, very technical. There's a bit of risk involved with it, or there's a lot of risk involved with it if it's not done properly and managed with care.
Yep.
So I'll just put it out there because I love saying this, but you've got to get advice if you want to consider this strategy.
Yeah, no, and this is, especially for something like this, you're definitely increasing a little bit of risk. The complexity associated with it, it's massive, and you want to make sure that you're doing it in the right way, because if you're not, the implications are huge.
Andrew, run us in. What do we do with a debt recycling strategy?
Yeah. So effective. Look, I think the easiest way to explain it is kind of explaining who it's best suited to, because it's not right for everyone, but really type of people that are best suited to this kind of strategy is, number one, you have to have equity in your family home. So generally you want your equity to be relatively large in order to justify going down a debt recycling strategy. And just for a really brief synopsis, equity is basically, the value that your home is worth. So the property that you're living in, let's say it's worth $1 million. The debt associated with it might only be $500,000. You've got $500,000 in equity. So you want to have equity in your family home in order to be able to enact a strategy like this. And generally, the higher your taxable income, the better that this strategy will work, because you're getting a greater tax deduction on the debt recycling part of the strategy. You usually want to have relatively high risk tolerance because you're obviously utilizing debt in order to be able to invest. And so you really need to make sure that your risk tolerance is there, and you probably want some experience with investing before you go into something like this. So for the most part, we generally advise our clients to invest for a period of time, get used to fluctuations, get used to putting money in, shares, property, managed funds, ETFs, whatever it is, before you start involving and complicating it even further with a debt recycling strategy, and you start to go down that route. So,
You want to throw
that's
it
a very long synopsis. I feel like I need to throw it over to you to explain your own question now. But yes, Billy, tell us, what is a debt recycling strategy now that we've worked out who it's best suited to?
So essentially the concept and the theory behind it is that you take that equity that you've got in your family home, you take that out of the home in the form of another split as a loan. Because you're taking that debt out of your house as for investment purposes, the interest becomes deductible on that debt that you've taken out. So essentially, you've got another facility, you withdraw from it, and you invest that borrowed money into an income producing asset. So first and foremost, the debt that you've withdrawn becomes tax deductible, so there is a tax saving there. The second part of the strategy is when you invest it in an income producing asset, the income that comes from that asset, and let's just make an assumption just to help the explanation, that you invest in shares. If you've got high dividend yielding shares, the income that comes off that, you use that income to pay back your owner-occupied debt. So you're not using that income to pay back the debt that you've used to invest in that asset, you're using it to pay off the debt on your owner-occupier. So what you're doing is you're using deductible debt to purchase the investment, then the income that the investment is deriving, you're using that to pay back your owner-occupier and your non-deductible debt. So it's going to be hard to sort of describe this, but for those that are watching on YouTube, essentially what you're doing is your non-deductible owner-occupied debt is going down at a faster rate, and your deductible debt, which is the stuff that you've borrowed, is going up essentially at the same rate.
Yep.
So the amount of debt that you owe is the same at any given time. You're not actually paying back your debt, you're just changing the percentage mix or the mix between non-deductible debt and deductible debt. Now, in the first year or 2 or 3 years, that's not really a huge benefit or a huge impact in terms of the change that you can see on your non-deductible home loan. But over a period of time, what ends up happening is you get your home loan down to zero, so your non-deductible debt is out the way. You've got this investment that's producing all of this income, plus you've got the debt associated with it, which is deductible. So when you take all of those things on balance, in the right environment, in the right scenario, for the right person or for the right people, you actually get to a stage where you pay off your home loan much, much, much faster. And in this instance, actually discharge all of your debt faster.
Yeah.
So you end up saving not only time, but you end up saving money in terms of interest saved as well.
Yeah, no, absolutely. And the other thing that's massive within all of this is we're not talking about months off your home loan. When it's enacted in the right way and when it's followed through all the way till the very end, you're talking about years. So it's very significant in terms of the amount that you're actually saving off the back end of it. Now, to kind of maybe put some numbers behind it, and at least kind of contextualize it a little bit, let's use that exact same scenario. You've got $500,000 worth of debt and you've got a property that you're living in that's worth $1 million. So let's basically put, Billy's strategy into action and say, all right, we're going to take out, say, $250,000 additional debt, right? So your debt is going to go back up to $750,000. Now that $750,000 is going to be split into two. So you're still going to have your $500,000 debt. Nothing has changed with the owner-occupied debt. You're now going to have a $250,000 debt associated with that property as well. And you're going to take that money and put that into shares, right? Blue chip shares that are deriving a passive income and providing dividends or high dividend yielding investments. Now you've got a $250,000 debt that's tax deductible because it was utilized for investment purposes. So the interest associated with that $250,000 is tax deductible because you put it into shares, and that $500,000 loan is still there. When that income producing asset provides income, so let's say the dividend yield on it is 5%, right? So 5%, you're getting $12,500 a year in dividends from that investment. You're using that $12,500 in order to pay down your $500,000 mortgage.
Mm-hmm.
So you're not paying down that $250,000 that was tax deductible because you want to maximize that debt, but you're actually physically paying down the owner-occupied debt that is not tax deductible, and you're paying that down further. So what you're doing is you're actually increasing your investment debt while decreasing your owner-occupied debt. And at the end of the cycle, so you do this over a number of years, potentially take out more equity and continue to recycle this strategy over a number of years. And all of a sudden, that owner-occupied debt that's non-deductible goes to zero, and what you're left with is a fully deductible debt, or the interest is fully deductible, and you're still living in the property. You haven't needed to move out or make an investment property or do anything like that.
And you've still got the underlying investment as well too.
Yep.
So at that point in time where you've got 100% deductible debt, you've got a portfolio of income producing assets, you can either do the same thing, or you can sell the portfolio, do the same thing as in divert the income into that loan to pay itself back. Or what you could do is you could sell down the asset and discharge the debt.
Yep.
So you've got a few options from that perspective. So what we really like about this strategy is that you have multiple assets growing at the same time. Not only is it just, say, you own or occupy your principal residence, but you've also got an investment platform or a group of investments and a group of assets that are growing alongside your property. And then you're also taking advantage of the tax opportunity that this presents itself.
So I think one of the really nice takeaways out of this is, when you're talking about wealth creation, when you're talking about investments, there's probably a few things that you want to do when you're looking at that. Number one, you want to grow your wealth, so you want to invest.
Yep.
Tick. That's what this strategy does. It allows you to invest. Number two, you want to minimize the tax that you're paying along the way. Tick. Does that. You want to pay down your owner-occupied debt because it's debt that effectively isn't doing anything for you. Tick. Does that. So in terms of the number of things and the number of boxes, now this can't be it. Like, you can't just do this and this is the silver bullet, everyone's rich, happy days, wealth creation's done. But you incorporate this as a part of a strategy, and you're diversifying, you're making sure that you're growing your wealth, you're reducing your owner-occupied debt, you're maximizing your tax position. I mean, it's really hitting a few big key things that you effectively want to incorporate in your financial plan and in your financial planning journey, albeit taking on, an element of risk that's associated with it. And so you need to be comfortable with that, and you need to have an adequate mitigation strategy. But it's really ticking a lot of those boxes that we want to see in a good quality financial plan.
Yeah. Look, I think it's a worthwhile strategy for the right people. It's something that we recommend. It's something that I'm doing personally as well too. But we can't downplay the risks. So we might just talk about some of the risks associated, because the positives, I think, are fantastic, but you need to go into this with your eyes wide open, because it can mean that you pay off your debt faster and your overall financial position is enhanced and accelerated. But look, some of the things associated with it, you need to feel comfortable really with a handful of things. First, you need to feel comfortable with investment markets, especially in periods of high volatility, because if markets are jumping around, you need to hold your position to maintain the course. So that's the first one. So if investment volatility is something that makes you nervous, this isn't the strategy for you. You don't want to get into this strategy because it does take a little bit to set it up. There's a bit of cost associated with it in terms of advice fees, but it's not necessarily something that you'd start today and you want to terminate in 6 months' time.
Yep.
It's just a waste of time if you're not invested in the strategy for a long term. So the being comfortable with volatility is probably the first one that I can think of. The second one that I can think of, and this one is probably the harder of the two, is ordinarily when you make your mortgage repayments, you see your outstanding balance that you owe the bank reduce. Albeit it's a little bit and it's very small. We wish that it had happened faster, but month in, month out, you actually see your balance that you owe reduce. Now, with a debt recycling strategy, if you're doing it correctly, the balance actually stays the same. It doesn't reduce, because anything that you reduce your owner-occupied debt by, your non-deductible debt, you're actually increasing on the other side with investment debt.
Yep.
So actually, let me backtrack a little bit. You are seeing the overall debt coming down in line with your contracted repayment. So that still needs to happen to meet the contract. But essentially what's happening is debt's decreasing on one side, being your owner-occupier, yet it's increasing on the other side, being your investment debt. So you need to feel comfortable that from that position, you see kind of one balance go down, yet you see the other balance go up.
Yeah. And the other thing that you really need to do, or that you really need to consider is, do you have adequate insurance cover? Do you have adequate cover around, hey, if something happens and I need to exit this position, number one, can I do it? And what are the implications going to be? But number two, if something happens to my income and I'm not able to continue making debt repayments, you need to make sure that you've got, your permanent disability covers, you've got your income protection covers in place to be able to take care of the fact that, hey, if something happens to my income, I'm still going to be okay. I can still continue with everything and everything's still going to be fine from a financial perspective and a cash flow perspective as well. Now, we think that should be the case whether you're embarking on a debt recycling strategy or whether you just have a mortgage irrespective. So that definitely should be a strong consideration in any financial plan, but especially important when you're considering something like this as well.
Yeah. So if I'm hearing this correctly, you need to be able to pass the sleep test with all of it. You need the capacity to be able to service the debt.
Yep.
You need the capacity to be able to borrow the debt. You need stability with your income or your earnings. Insurances are a huge consideration. You definitely need insurance, specifically income protection and life and disability cover. You need to make sure your estate planning is up to date and taken care of. And you also need to make sure that you've got your emergency fund or your liquidity cash sorted out as well too.
Yeah, absolutely. Absolutely. I mean, another way to think about a debt recycling strategy without going the full 9 yards. I think that's a saying, full 9 yards?
10 yards, I think.
10 yards, maybe. Okay, maybe. It's an NFL. Is it an NFL reference?
Yeah, because NFL, once you go 10 yards,
yeah.
it resets itself.
Yeah, okay. Yeah. Sorry, I digress.
Go the Eagles.
Without going the full 10 yards, you can kind of do this strategy, but to a smaller extent. And I'll use an example of a client that I recently did this for, because they didn't want to fully go down a debt recycling strategy. They weren't necessarily comfortable with that, but they had a portfolio of investment that had previously been set up, and that was valued at $100,000, right? Approximately, give or take. Now, because of the way that the market had been performing, the capital gains implications of selling down that portfolio were basically zero. So, $100,000 investment portfolio invested in managed funds. They also had a mortgage that they were living in. So a property that they were living in, owner-occupied property. So what we did was we took that $100,000 portfolio, sold it all. Use that $100,000 portfolio to pay down their owner-occupied, non-deductible debt.
Yep.
Then we took out another loan of $100,000 from that same property, and that loan was used to put back into an investment portfolio, exactly like what they already had. Now, because that loan was taken out and it wasn't contributed to with their own contributions, the debt associated with it, tax deductible, debt recycling strategy 101. So all of a sudden, they've reduced their owner-occupied mortgage by $100,000 down to $400,000.
Yep.
They've increased their tax deductible portion of their mortgage from 0 to $100,000. Debt positions remain the same. They haven't actually taken on any more debt, but all of a sudden, a portion of their owner-occupied debt is tax deductible. So another way to kind of utilize some of the benefits of a debt recycling strategy without going the full way, and still be able to take advantage of some of the tax benefits really that are associated with it as well.
Yeah, so that's just doing it as a lump sum, which is actually an easier way to describe what a debt recycling strategy is. But doing it as a lump sum rather than doing it on a continuous basis.
Yeah.
And if you then overlay, I guess, some of the concepts that we've been talking about over the podcast, like your dollar cost averaging strategy, averaging into an investment over a period of time obviously makes investment sense, but this is also another way to do it for clients that, you know, maybe want to take a different approach with it, that feel comfortable knowing that, hey, my debt is $100,000 and that's where it is.
Yeah. And it's another way to be able to, you know, utilize someone that's already halfway down the road. Like you've already got an investment account. All right, how do we actually maximize the position if it wasn't set up that way from the beginning?
Yep. Andrew, I think that was a nice, short, sharp, succinct description about what debt recycling is. I think we covered off on everything that we wanted to get across to our listeners and our viewers.
Yeah, no, absolutely. It always is something that's a little bit exciting because you're talking about wealth creation, you're talking about minimizing tax, you're incorporating a few things into the one strategy. So, always love talking about debt recycling strategies.
Fantastic. And to our listeners and our viewers, if you've got any questions, feel free to reach out. We're always around to have a chat. It's definitely a more complicated strategy. So if it is something that sparks your interest and you want to have a conversation, you definitely need to talk to a financial advisor about it. This is not something that you'd be able to do by yourself. So feel free to reach out either to us or to your financial advisor and get some advice and see if this strategy is right for you.
Yeah, absolutely. And make sure that you like and subscribe to the podcast, and we look forward to catching you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.